Chapter 3. Let's see how the costs behave. As we said in chapter 2, costs behave two ways: as a variable cost and a fixed cost. Let's start again with the total variable cost. Total variable cost always and always increase or changes with the proportional to the level of activity within the relevant range. So what that means, what's going to drive the variable cost? So many things. Unit produce, more we producing in order to sell, more we have to, variable cost we're going to have. Less we producing, less we have to, less variable cost. The other thing, machine hours driven. Machine hours, that's for the machine. If our machine work more hours, then the cost is going to go up. Variable cost for the electricity, let's say, or for the material which are used for that machine is going to go up. If less is used, less variable cost. Labor hours is the other thing that can drive the variable cost. Miles driven is another thing that can drive the variable cost. The true variable cost always and always increase with the level of activity and remain zero if we're not using it. Again, we're gonna go the potato, you can buy it in bulk. Let's go with something else. Let's go with the usage, what you're paying based on usage. Let's go with the tomato now. Don't tell me that you can buy tomato in bulk. Probably you can, but let's go with the tomato and pound per tomato. Again, pound per tomato always gonna stay the same. What's gonna drive the cost is the pounds that you're buying. Or coffee. Let's go and buy a coffee. Let's go buy coffee from Tim Hortons. That's relatively not so cheap, but not so expensive like Starbucks, for example. So Tim Hortons, if you buy, you already know if the cost for medium coffee is $1.50, you know if I buy one coffee, it's going to be $1.50. If it's two coffees, $3. If it's six coffees, $9. If I don't buy, then I don't have to pay. That brings us to variable cost per unit. Variable cost per unit always stays the same. Again, Tim Hortons, medium coffee, $1.50. McDonald's, small coffee, $1. Today, $1. 10 coffees, $1. Not buying, $1. It doesn't matter what you're going to do. The cost is there. Per unit is never going to change within the relevant range again. So how the variable cost is within the different organization? Well, if we have a large investment, if we're a company with public utility with a large investment, then we're going to have a few variable costs. What the people doing right now, I mean, not the people, what the big corporations now doing to eliminate or to reduce the variable cost related to the direct labor, they creating artificial intelligence. Why? Because they're putting a large investment on the artificial intelligence, hoping to let the people lay off and reduce the variable cost, which is related to the labor. The other example here is, imagine you are a Toyota manufacturer and you're producing this facility, which is a closed facility run by the robots and artificial intelligence inside. So you just need two people, one to monitor the activities and to follow the line, and it just the material coming, everything is scheduled. Inside the preparation, the robots doing what they're doing. Do I need lights in the facility? No. For the robots, they don't even know if it's a day, if it's a night, is it a start holiday, is it Christmas, if it's not Christmas, they just keep working. So what's going to happen? The variable costs will be fewer. Now, if you're a service company, however, we're going to have a high proportion of variable costs related to the service our clients, as a labor, as some small materials. Merchandising company, of course, high proportion of the variable costs. Why? Because the products that we're buying and selling that's our variable cost. If we want to generate more sales, obviously we have to buy big variety of products, which are customer want based on the customer demands. Manufacturing company, again, many variable cost. So based on the type of organization, merchandising company, cost of goods of the sold of the merchandises, it's gonna be the variable cost. Manufacturing company, direct material will be variable cost. Direct labor as a wage is gonna be labor cost, the variable cost. A variable portion of manufacturing overhead, power, lubricants, supplies, those will be variable cost. Both merchandise and manufacturing company will be selling general administrative cost, which is sales commissions. More they selling, more you have to pay. Less you're selling, less you have to pay. Shipping cost. For the service organization will be supplies, travel, clerical cost, anything like that. True variable cost, obviously direct material is the true or proportionately variable cost because the amount used during the period will vary in the direct proportion of the level of production activity. So once more you're using it, more production, more materials. Less production, less materials. Step variable costs. The step variable costs, we can think about labor, specifically labor of the maintenance. Maintenance, where in which business? Probably hotel business. So in our hotel business, if we have, let's say, 100 rooms in our hotel, and we know that during the busy season, all our rooms are occupied, then we need more maintenance workers to maintain our clients. But if we know in the slow season, our occupancy is between 20 and 50 rooms, then we can cut on the half of the people of the maintenance, and we keep only one or two people to be available on that time. So again, it's a variable cost, but it's the variable cost. Then this one, what make it variable small, that the small changes in the level of production are not likely to have big effect. So basically, if the occupancy of the room is one or two going up or going down, we can still maintain it with the current workers. But if the change is a little bit, let's say, 10 more, we see the 10 more customers coming with it, and we need to service 10 more rooms, then we have to hire another person, which also that person still going to be paid on based on hours. So if we wanted more, we can give him more hours. If we want him less, we're going to give him less hours. But we have another person available. Now, in order we to predict the cost, we're trying to find a relevant range or segments of the activity where the variable costs behave as a true variable cost. Means it can be expressed by formula, which formula is affect the increase in the variable cost only based on the level of activity. For that reason, we're trying to see what the actual cost is. The actual cost is always going to have a curve. Based on that curve, you're going to see the part of the graph where the variable cost stays as a straight line. For that part of the graph, we're going to try to come up with the formula, and that's how we start predicting the cost. The whole point is, why do we need to do all this cost analysis? Going back to the cost, find out how the cost behave, why the cost behave this way. Is it relevant to us? Is it not relevant to us? What else we can understand about the cost? What is variable? What is the fixed cost? What do we need to do all these exercises? The reason for all those exercises and all this different classification and different analysis is only one. We to be able to predict based on the past experience and then to make decisions which are intelligent, data-driven decisions based on the information and based on the analysis, which again is driven by the data from the financial reports that we already have, by finding the pattern and try to predict, put it in the formula, try to predict it. We're not any different. Artificial intelligence is not any different than us. The only thing with artificial intelligence is doing the calculation in the split second and using a way more capacity, cerebral capacity, if you want to put it there this way, compared to the humans. If we have the capacity to use our cerebral capacity or our brain on the level of artificial intelligence, we're going to beat that artificial intelligence 1,000 times, I can tell you. I can guarantee you that. Why? Because we are more intelligent. I'm sorry that I have to bring this to you, but we are more intelligent. And I have proof of that, but I'm not going to tell you today. I'm going to tell you another time when the time comes. When the time is right, I'm going to show you what I have experienced today. So again, for the relevant range, we need to be able to predict the cost by using a formula. That's why we're chasing where the costs behave as a straight line. Find the formula, use it and apply it and predict the cost. Fixed cost. Fixed cost in total remains the same, always, within the relevant range. Now let's think about the fixed cost. Fixed cost can be monthly pass for the public transit. It can be ticket for ski pass, day pass for ski. Can be rent. It can be your telephone bill. Most of you, I believe you are on the plan, correct? Can you guys hear me? So most of you are on the plan, correct? How much you paying for your cell phone? 35, 45, $50? Let's pretend that you're paying $50. $50. What you get, you're getting unlimited calls and unlimited text messages, correct? So if you're paying $50 for your plan for the cell phone and you're sending only one text message, how much is the cost for that text message? It's going to be $50, right? If you're paying for the plan monthly, $50 for unlimited messages, and you send only one text message, that the cost for that text message will be $50. Now, how about if you send 1,000 text messages? How much will be the total cost? Still going to be $50. Make sense? So the number of the messages that you're sending, the usage of that cost is not going to drive the cost higher or lower. It's going to be the same. Fixed cost stays the same. Annual insurance for your car. What kind of cost is that? Obviously, it's a fixed cost. What that means? That means driving, not driving the car, more you're driving, less you're driving, the cost is the same. End of the story. That's in total. How about per unit? Well, per unit is the tricky part. Now, let's go back to the cell phone. So your text message, if you send one text message, total cost is $50. If you send $1 million, 1 million text messages, cost is $50. How about cost per text message? If you're paying the $50 and you're sending only one text message, how much is the cost for that particular text message? It's going to be $50. If you send two text messages, the cost drop down twice, 50%, just 100% go down, 25%, $25. If you send 10 messages, then what's happened with the cost? Reduce 10 times, now become $5. So what's your incentive here? To send as many text messages as possible, correct? That's the only way you to reduce the cost of text message and utilize that cost. Now listen to this. I understand this because I'm teaching this subject. I understand this. I understand that you have to make your fixed cost work for your benefits by using the fixed cost as much as you can so you can reduce the cost per single unit. That's why in my courses, every time when you come to my courses, even in online or in the classroom, text. Please text. Because again, I understand that's the only way you to reduce the cost per text message. In my classes, you can text unlimited time. Also, use the time as much as possible to text. But then I'm going to ask you the other question. How about the cost for the course? What kind of cost is that for you? It's a fixed cost. So now think about it. You know how much you pay for this course. If you pay attention for this course, in this course, if you pay attention only 1 minute, how much is the cost for that minute? It's a lot, right? So what's your incentive there? How can you reduce the cost per minute in for this class or any class? To pay as much as possible attention. Is that what you're doing? That would be my question. Is that what you're doing? Because if you're not doing it, then you're wasting your money. Now, but and the other thing is now we have a dilemma you have a dilemma to solve. One is now what should I do now in class? Should I pay attention or should I text? And if we come up with the calculation that the cost per text message is more than the cost of paying attention in class, then text. But if you come up with the calculation that the paying attention in class is cost you more than the text message, then I'm going to ask you what kind of manager you are and why you're wasting your money. Make sense? Same thing with the fixed cost, you have to understand. The fixed cost is the tricky part. The fixed cost is the opportunity that you're going to have in business to make the difference. The other example will be, let's go to, this year there was not much snow, obviously, but let's pretend that we're going for ski. And we're going to ski in Seymour here, in the local mountain. Let's go to Seymour. And I haven't been in Seymour for like 2 years after I broke my leg. I mean, I didn't broke it, but the person broke my leg. I haven't been on ski, so that means like 2 years now. I haven't touched the ski. But anyway, a long time before when I was going there, the evening pass was like a $60, I believe. I don't know how much is that, but let's say now the 60, that $60 is no longer 60. Let's say after 6 o'clock, it's $100 in Seymour, and pretend that there's a snow and you're going there. So what you're gonna do? You're gonna buy a ticket, and you're gonna say, no, I'm not gonna use it. I'm just gonna go back home. Is that what you're gonna do? Probably not. So what you're gonna do? You're gonna start skiing. How many times you're gonna go? You're gonna get the fast. That's why I like Seymour, because they have this super fast lift. For like 2 minutes or 3 minutes, you're up. So you're going there. You run 2 times, and then you're gonna say, okay, I'm done for tonight. Let's go. Is that what you're gonna do? Probably not. Then what you're gonna do? You're gonna ski like crazy. Why? Because you pay $100. And you know that from 6 to 10 o'clock, you have 4 hours. So for those hours, you're gonna utilize that cost as much as you can. One year I fall down, I injured my shoulder. So what's happened is I was thinking that I broke my collarbone here, and I was scared to touch it. Right, it's massive pain. I should have fallen on my shoulder, and I said, okay, yeah, I broke it. So it touching. Oh, there's no broken. Push a little bit more, no broken. Okay, so let's go one more run. And one more run, and I made 10 more runs after I fall down. So I'm going home. I'm trying to take out my jacket. I cannot move my head. I cannot even lift it. So that's what's happened with the trying to utilize the fixed cost as much as I can. So for the fixed costs, we have two types of fixed costs. Remember this, pay attention, please. This is important. I want you to understand this. You have two types of fixed costs. One is committed fixed cost, the other one is discretionary. What makes the fixed cost committed? When you have a commitment, long-term commitment. What means? That means you sign somewhere paper with the promise that you're going to continue with that cost for the long period of time or whatever in the terms, and you have everything fixed on the paper. Committed costs will be mortgage, could be cell phone under the current plan for 2-year plan. It can be purchase of some equipment or some motor vehicle, which you have to make a monthly installments, or buying ICBC insurance, which you're paying every month instead of lump sum at the beginning of the year. Those are committed fixed costs. There's pretty much no room for you to change them. So if something happened, you cannot easily get rid of them. In some instances, you cannot even reduce them. Discretionary cost is something different. Discretionary cost, you can cut it on the short term, which means what will be the discretionary cost? Imagine this, you're renting an apartment. Most of the apartments now, they ask you to sign a contract for 1 year. So after that 1 year, there's no more contract. On the rent, you don't need a long-term contract. That's not a lease. That's why they not make it more than 1 year, because if it goes more than 1 year, that become a lease. And that's legally not on the purpose of the rent. And so once that year passed, then you're going month to month. The cost not going to change, but if you feel that the cost is too much, you just can't cut it. Same thing with the plan with the cell phone provider. Yes, you have 2 years plan, you're staying on the plan, but after 2 years expires, you're staying on the same kind of conditions that you're paying, but now if you don't need it, you can cut it. Why I'm telling you this? Because apparently 95% of the professional players in North America don't get it. That's why it's very common. Statistically speaking, more than 90% of the professional players get bankrupt within the 3 to 5 years after they stop playing. Why? Because they equip themselves with a lot of committed fixed cost. They make those commitments when they're making the ginormous income. They stop playing, the income's not coming, but the costs keep going. By the time they figure out what's happening, they're running out of cash. So if you see some famous professional player, who starts showing on the commercials and showing here on the public events, he's run out of cash. Now he tried to find some other sources of cash. Why? Because again, the committed cost eat everything. The other thing that I have to tell you, if ever happen in your life to get laid off a job, don't start crying. What you have to do is sit down and start chasing the cost that you have in your household, Figure out which one is fixed cost, which one is the variable cost. From the fixed cost, figure out which is committed, which is discretionary. Which of those, once you find which is discretionary cost, figure out which one of those you can eliminate for the short period of time. Means the time that you don't have that income. And once you find your job, once you get back to your feet, add it back. That's one thing that you can do. Variable cost, you can control it to some extent. Why? Because you can adjust your usage. But on the fixed cost, if it's discretionary, you can easily eliminate it until you get your income back to normal. Now, what's going to happen? The trend with the cost is towards the fixed cost. So means that the variable cost on the long term is going to become more like a fixed cost. Or the other thing is that you naturally, if you start running your business, you want to go on the fixed cost. Why? Because you can predict them. Variable costs, they fluctuate. Yeah, but sometimes you cannot, it's very hard for them to predict. For example, I'm going to tell you this. And sometimes actually you want the fixed cost rather than the variable cost. For example, pretend that you already hired on the co-op students from Douglas College. You found that this student have something super unique. He's very um, detail oriented, solve the problem very fast, and he has a very solid foundation as a human being and as a professional. But currently, he's on wage, means he's hourly worker. How can you lock him for the long period of time? What you gonna do? You want that student in your company. What you gonna do? How can you keep the student? Any suggestions? Currently, he's working on hour. You're paying him $25 per hour. Are you guys there? Or you're gonna offer 30, or you're gonna move him to salary. Yes, that's exactly what you're gonna do. You're gonna move him to salary. Do you understand the idea with the wages and salary? Wages is you pay per hour. If you're working 8 hours, pay you 8 hours. If you're working 6 hours, you're paying 6 hours. Salary, I'm paying you lump sum, 2 times a month, 15, 30th. And that's all. So basically, you want to move him on the fixed cost so you can lock him in the company. That's why it's very common thing with the sports teams. What they're doing is they offer fixed contract to the players, so they want to lock them for the period of time and now become a fixed cost. The other example for how the variable cost can become a fixed cost is very simple. Imagine driving a car. Cost of the gas. What kind of cost is variable or fixed? It's a variable cost. More you're driving, more you're paying. Less you're driving, less you're paying. But there's a catch. You just got a job. You're living in Vancouver, downtown Vancouver, and you got a job in Abbotsford. Every day you have to drive 50 kilometers to the job and 50 kilometers back. And you like this job. You're planning to stay with this job on the next 5 years. Now, what kind of cost is the driving a car? Now become a fixed cost. Make sense? The other example will be grocery. What kind of cost is variable or fixed? It's a variable cost, right? More you buy, more you pay. Less you buy, less you pay. Can you stop buying groceries? No. So for some extent, you need that cost, right? Even though it's variable. So in the long term, if you know that you're paying for the grocery between 250 and $300 per month, what kind of cost is that now for you? It's a fixed cost. Make sense? So that's why the trend is to move to the fixed cost. Now, the other one is the fixed cost is the relevant range. The relevant range in the fixed cost is, imagine this, you have, I know you don't buying the monthly pass for the public transit, but let's say for for the relevant range will be, for the monthly pass will be one zone versus two zones versus three zones. On the rental will be one bedroom versus two bedrooms versus three bedrooms. And you can see how exponentially the costs increase. Now, compared to the step variable cost is very small adjustment where the relevant range of the fixed cost, you jump in the higher level. Usually the cost doubles with the fixed cost. That's why when you start using the fixed cost, you want to be somewhere at the end of the utilization of the fixed cost. And if you jump to the next relevant range, you don't want to jump on the beginning of the next relevant range. You want to move as further as you can from the start of the next relevant range, ideally somewhere after the middle. I show you the example with the chairs in the room and the waiting list. So if I have 20 chairs in the room, I have to pay $2,000. But if I want more chairs, yes, but they have to move to the next relevant range, which is 40 chairs. But for the 40 chairs, the cost of the rental increased double the cost. Now, most of the businesses, they don't realizing that. Most of the businesses, they're working on the capacity, they're seeing the people start getting money, they're getting greedy. And they have, because they're not chasing now the demand, they're thinking that if they move to the next relevant range, means if they increase their business, they will be able to make the same profit. And they're moving to the next relevant range. But now the difference between the way they are and the next relevant range is ginormous. So the fixed cost double. In the beginning, they're not realizing that. Within the 3 months, they're out of business. It's very common you to see profitable business, try to move to the next relevant range or try to increase the business, and after 3 to 4 months, disappear completely. Why? Because they misjudge the increase. They thought that the additional small amount of sales is going to cover the additional cost, and they made a mistake. Too late. Next business. So the relevant range of activity for the fixed cost is the range of activity over which the graph of the cost is flat. Means the same. If the office space is available for rent for $30,000, that means the increments is 1,000 square feet. So for every $1,000 square feet, next increment is 30,000. So for 30,000, 1,000 square feet. For 2,000 square feet, 60,000. Which of the following statement, let's go with this, about the cost behavior is true? Let's go with this. First one, fixed cost per unit vary with the level of activity. Is that true? Well, let's see. Fixed cost per unit. How is it with the level of activity? Is it true? Is it vary or not? Or stays the same? Varies. So is it true? Okay. Next one. Variable cost. It's true. Variable cost per unit are constant within the relevant range. Is this true? It is true. Let's see how the variable cost per unit behave. Variable cost per unit should behave like, let me see the graph. No, that's a step variable cost. Where is it? There you go. Variable cost per unit. Is it the same? It's absolutely the same. It's a constant. Total fixed costs are constant within the relevant range. Is that true or no? Total fixed costs, relevant range, stable. Flat line. How about the total variable costs are constant within the relevant range? Is that true? Let's see what the total variable cost. No, that's false. Yes, it is false. Why? Because the variable cost usually that's what's happened with the true variable cost, increasing or changes within the level of activity. So what I want you to understand is we as an accountant, we don't like this. We don't like going up or going down. We kind of we can be happy with cost constantly going down, 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 but we are most happy when we see flat line. When we see flat line, our users of financial statements are happy. Why? Because they want to see fluctuation. That's a unique kind of situation. In accounting, we don't like fluctuations. Our managers, they don't like fluctuation. Our users' financial statements, they don't like fluctuation. Now, in other discipline in life, like medicine, they don't like flat line. They like fluctuations because the flat line in medicine, that means we didn't do a good job. In accounting, when we see flat line, that means we did a great job. Why? Because there's no changing compared to previous period. We are exactly the same. Everything's perfect. In medicine, that's not the case. They want to see fluctuation. They're going to go up and down, up and down, up and down, up and down. That's how you should remember it. Variable cost per unit, flat. Fixed cost in total, flat line. Variable cost in total, go up and down, depends on the usage. Fixed cost, going only down. Is ever going to reach zero? Never. Why? Because it's a cost. You already pay for it. You can reduce it. You can go 0.0001, but it's never going to go zero. And that brings us to, obviously, those three are correct. That brings us to the mixed cost. And what is mixed cost? Mixed cost is something very interesting. That's combination between the fixed cost and variable cost. How are we going to express this? Now, if we have the fixed cost and the variable cost, how are we going to get the total cost? Well, the total cost obviously we're going to be the fixed cost plus the total variable cost. Now, what's going to drive the variable cost? Cost per unit and usage. So that's why the total mixed cost now is going to be the total fixed cost, which is a flat line, never changes, plus variable cost per unit, which is also flat line, and the number of units that we using or level of activity in this case. Now the question is, if your fixed monthly utility charges is $40 and your variable cost is 0.3 cents per kilowatt, and your monthly activity now is 2000 kilowatts, what's your amount for your electricity bill? Obviously, applying the formula total cost is going to be the fixed cost portion, which is $40, plus variable portion, which is 2000 kilowatts times 3 cents per kilowatt. And that's going to give you the $100. Who's going to tell us which cost is mixed cost? Which one is variable? Which one is the fixed? Well, we have two approaches. One is the accounting analysis. The other one is the engineering approach. Engineering approach, where we're going to go? We're going to go to the manufacturing department and we're going to start asking the production manager, hey, Materials. Tell us how that cost behavior, what you're doing with the materials, and we determine the behavior, the cost. Labor, same thing. Overhead, same thing. Accounting analysis, we're going to check the accounts. We're going to see from the invoices with the accounting information how the cost behave, and we're going to come up with the idea. The whole point is, why do we need all those things? Again, I told you, all this analysis that we're doing with the variable, how the cost behave, we need it for only and only one reason, to predict the cost, which cost the total cost, obviously. So one way to predict the cost is called scattergram plot. What we're going to do, how we're going to do this? We're going to put a dot every time when the actual cost comes. When the actual cost, we're going to put a dot. Then we're going to put a line that eliminates the fluctuation between one and the other. So you're going to try to put a line which balance each other on all the fluctuation. Then for that line, we're going to come up with the formula. And then we decide to predict the next month what's going to happen. That's one way to do it. Again, if we have enough statistical data from the past periods, we can easily come up with the formula. And when we use that formula, we can predict the cost. I'm not going to spend time on this method. This method is not examinable. The method that is examinable, though, is the high and low methods. In high and low method, you're going to see it on the assignments. You're going to see it on the midterm exam. So for the high and low method, how this works, I'm going to move to Excel spreadsheet. So on the Excel spreadsheet, I already have the information. So let me share my screen. Give me a second to share my screen. So what we're going to do, we're going to have, first, we're going to have enough information. What will be that information? We're going to have information for the months. We're going to have information for the usage, which in this case is hours. And we're going to have information for the total cost. Once we have this, since the methods is high and low method, it's high, low method. We're going to get the highest point of usage. Where is the highest usage? So what we're going to do, very simple, we're going to put here max, bracket, and we're going to get the maximum value of all those cells. And obviously the maximum is in June, where the hours used are 800 hours. Then we're going to check where is the lowest usage. And we're going to get equal to minimum of all these numbers. And we get the minimum is at 500 hours, which is happened in February. Now, June is my high, February is my low. Next thing that I'm going to do is I'm going to get the cost of that particular month. Not anything else, that particular month. So what I'm going to do, I can use vertical lookup if you like the vertical lookup. So basically, you're going to go with the vertical lookup, and then you're going to put the range, the level of the value that you're looking for, and you're looking for this value in this table. And once you find the, let's go again. Looking for this value in this table. And once you find the value in the first column, I want you to take out the information from the second column, if it's not false. And once the formula find 800 here, drag the cost for that particular line. Same thing with this one. Again, vertical lookup. You're going to use the formula. What we're chasing the value 500. Way we want to find it in this tray, in the first column of the tray. If you find it, then in the first column, then take the information from the second column. If not, false. And we get in February $7,400. Once we do this, we're going to do very simple. We're going to find the difference. Difference between usage will be 800 minus 500. And then we're going to get 9,800 minus 7,400. Boom. No. Why do we need the difference? Because from the difference, now I can calculate how much is my cost per hour of usage. And the cost per hour is going to be dollar per hour. Correct? So what will be my nominator? My nominator will be cost. My denominator will be hours. And I'm calculating that based on the high-low method and the difference, my cost per hour is $8. Now, what do I need this for? Because I already know, let's go back to the original. I know that the total cost is equal to my fixed cost plus my variable cost. Also, I know that the variable cost is equal to the units of usage time cost per unit. So my total cost is actually the fixed cost plus variable cost per unit or number of the units time variable cost per unit. So what I just calculated, I calculated my variable cost per hour, which is my usage here. Now, when I have this formula, I need this formula, and I'm going to move it here. Now, the question is, I have total cost. I have number of units. I have cost per unit. Can I calculate the fixed cost? In order to calculate the fixed cost, we can use either the high usage point or the low usage point. Let's go first with the high usage point. What do we know about the high usage point? On the high usage, my hours use is 800 and my cost is $9,800. That's what I know. So from the formula, again, I'm going to flip the formula here. I'm going to start substituting. Total cost, I already know it. My total cost is $9,800. I already know that. I know that fixed cost is the one that I don't know. But in the bracket, what I have? In the bracket, I have number of units, which is 800. And that's time the variable cost, which is $8. The question is, from this formula now, can I express the fixed cost? Oh, how hard it will be. I'm going to have $9,800 on one side to be equal to the fixed cost plus, sorry, I missed the plus in the previous form, plus bracket 8 times 8, that's $6,400. And That should be my calculation here in the bracket. So let's put here the plus in this formula. So what that means? That means I can easily calculate that the fixed cost here is equal to 9,800 minus bracket 800 times $8 and close the bracket. $3,400 I'm getting for the higher point of usage. Now let's do the same calculation at the lowest point of usage to see what this is going to give us. At the lowest point of usage, we have used the 500 hours and our cost is $7,400. So again, that's my formula. Formula not going to change, but that's the beauty of the formula. Then I can start substitute. Total cost in this point is $7,400 should be equal to fixed cost, which I don't know, plus bracket 500 hours time $8 per hour. In other words, I should have $7,400 to be equal to the fixed cost, plus in the brackets I'm going to have $4,000. If I have to calculate now the fixed cost should be equal to 7,400 minus bracket 500 times $8. My fixed cost should be equal to $3,400. So as you can see, the fixed cost under both methods is the same. When you're doing your assignments, do you have to calculate both points? No, you don't. Once you get 1 point, you're done. Why do we need this? For only one reason. We need to come up with the formula which is going to help us to predict the future total cost. So what do we need in that formula? We need the fixed cost. And we need the variable cost per unit because those are stable. Again, we're looking for the cost which doesn't change within the level of activity or relevant range. We choose that variable cost per unit, fixed cost in total. They don't change it. So what will be my formula? My formula will be very simple. Total cost should be equal to $3,400, which is the fixed cost, plus now I'm going to have here number of the units times $8 per unit. So if your manager or owner of the company comes and say, hey, how much will be my total cost next month? What do you have to ask him? You have to ask him only one question, the way I see it. What will be that question? How many units or how many hours did you work? Make sense? Isn't that what ChatGPT asks you? Tell me how many hours I'm going to predict the future for us. Or how many, what do you want? And give me the right question. Give me a question, I can find the answer. Same thing. Now, you ask for a question, give me the question. What will be the order? How many hours you going to work? Give you the hours, move on. Yesterday, what I did yesterday is I paused this one in ChatGPT and ask ChatGPT using the high and low method. Can you tell me what will be the cost if we're using if the usage is 1,000 hours, and it worked. So if you want, try it. If you don't, I can post you the video from yesterday and you can watch it later. Do you want me to post you the video from the last night class? So you can see. Okay. Yeah, the comment of the people was, oh my God, Ivan, you look disappointed when ChatGPT came up with the answer. Yes, I was disappointed. Yes, I have to admit that one, but I can give it to you. It's calculating it within 2 seconds. That's the reality that you have to be with. And now let's go back to the slides and let's do the slides and complete the slides. Uh, I believe we should be okay. So now, again, high-low methods. You're getting the period, you're getting the usage, you're getting the cost. Then you're chasing the usage at the highest point and the usage of the lowest point, and associated cost with the highest point and the lowest point. Once you get those one, the highest level of usage with the cost associated to that level, lowest level of usage with the associated cost for that level, you're getting the differences. From the differences, you're calculating the variable cost per usage, which is in this case hours. Once you come up with the cost per hour, then you're moving to the one of the two, either the high level, either the low level, and start substituting in the formula. Which formula? Total cost is equal to the total fixed cost plus the total variable cost. Variable cost, you know, it's usage time cost per unit. Fixed cost is fixed cost. Total cost is already given to you. Express for the fixed cost, and you're calculating the number. Once you're calculating that number, then you come up with the equation, which is the total cost is equal to the fixed cost, which you calculate 3,400, plus number of units time cost per unit, which is stable now, $8. And that's how you predict the cost. So let's see this question now. Sales salaries and commissions are 10,000 when 80,000 units are sold, and 14,000 when 120 units are sold. Using the high-low method, what's the variable portion of the sales salary and commission? What's the difference in the cost? 4,000. What's the difference in the units? 40,000. Okay. So which one is numerator? Which one is denominator? Which is in cost per unit, correct? So which one is numerator? Cost or the units? Cost. Which one is the denominator? Should be units, right? So what we have on the numerator, what do we have? What's the number that we have? Should be 4,000, correct? Denominator, not 49, it should be 40,000. So how much is 4 divided by 40? Seems like a 10 cents, right? So what's the correct answer? Correct answer should be B. Okay, once we do this, what's the next step? To find out the fixed cost. which level we should use? Highest or lowest? Choose one of the level. It doesn't matter, right? So let's go with the highest. Highest, we have 14,000 total cost. 120,000 units, and cost per unit we already calculated is 10 cents. So what we have? 14,000 minus how much will be 120 times 10 cents? Okay, so the answer will be 2,000, which is A. Correct? Excellent. And now you can predict the cost. The next method is low square regression method, which I'm not going to test you. I want you to know that this method exists, but that's all I'm going to tell you about this method. So the last thing that left is only one thing. To explain to you what's the contribution margin and how many types of income statements we have. For that reason, I'm going to move to Excel again. And in Excel, let me share my screen. I'm going to open this new Excel spreadsheet and let's make it bigger like this. And let's go with the two type of income statement. One is traditional income statement, and the traditional income statement, everything starts with sales. Then we have a cost of goods sold. Then we have a gross margin. Then we have operating expenses, and then we have operating income. That's our traditional income statement. Let's put some numbers here and make it fancy. It's 1 and 2. Sales, let's say the sales are 10,000. Cost of goods sold is 4,000. That makes the gross margin 10 minus 4, 6,000. Let's put one line here. Then we have operating expenses, which are 3,000. And that gives us operating income of 3,000. Let's highlight it. Operating income of this one minus that one, $3,000. So the last thing that I need to do is to format the sales numbers, and we are perfect. And we have our traditional income statement. Now, the next type of income statement, now the traditional income statement, that's prepared for the external users, which are investors, creditors, and lenders. For the managerial purposes, for the managerial accounting, we're going to use income statement, which is different, which is called contribution. Income statement. Basically, it's going to give us how much the company contributes from different activities. Mostly from sales. Actually, only from sales. So, how this is going to work? Very simple. We're going to have the sales, that's not going to change. We cannot change the sales. Sales will be the same. The interesting thing is I cannot change the operating income either. So my operating income is going to stay exactly the same. I'm going to change the color, but the idea is going to stay, the number is going to stay exactly the same. Let's format those cells again. What's going to change then? Well, I'm going to pull the cost. I'm going to get these costs. I know my total cost. I have here cost of goods sold, which is 4,000. I have operating expenses, which are 3,000, and the total is 7,000. Correct? So I have my cost of goods sold, and I have my operating expenses. So once I know that, what I'm going to do, and I know that my cost is 7,000, what I'm going to do now is I'm going to get these costs, going to use either engineering approach or accounting approach, and I'm going to split them only on the way they behave, but only between two costs, variable and fixed. Which one? Exactly the same, $7,000. But now I'm chasing what's the variable cost and what's the fixed cost. Now, the variable cost, it might not be the same. It might be $6,000. Then what's happened now? Might happen that from the sales, my sales, less the variable cost, give me contribution margin of $4,000. After that, I have the fixed cost, which not changing, $1,000. And that's why my operating income is $3,000. Make sense? So again, you're pulling the cost of goods sold and operating expenses, and you chasing them, how they behave as a variable and fixed cost. You're not going to change the total, but you're going to allocate it now for the new way. Sales minus the variables cost going to give you a contribution margin. And after that, you're going to have the fixed cost, which is going to give you the operating income. And that's where we're going to stop today.